In September 2025, it seemed like Larry Ellison had pulled off one of the most unexpected moves in modern tech history. Without launching a groundbreaking AI model, without competing head-to-head with OpenAI, Google, or Anthropic, without inventing the next chatbot, yet somehow he appeared to be winning the AI race. Oracle's stock was surging at a pace not seen in decades. Commentators called it the company's biggest leap since the early 1990s. Financial headlines framed it as a renaissance story. The veteran enterprise software giant had reinvented itself at exactly the right moment. For a brief window, Ellison's net worth skyrocketed so dramatically that he even edged past Elon Musk on global wealth rankings. The narrative was irresistible. The database king had transformed into an AI power broker. But beneath the celebration, something far more complicated was unfolding. While investors focused on the stock chart climbing almost vertically, Oracle was undergoing a transformation that fundamentally changed the nature of its business. And that transformation came with enormous financial consequences. To understand the magnitude of that shift, we need to rewind to Oracle's origins. Oracle was founded in the late 1970s with a simple but powerful idea. Businesses needed better ways to manage data. The relational database, a structured way to store and query massive amounts of information, became the backbone of enterprise computing. Throughout the 1980s and 1990s, Oracle's database software became embedded in the world's largest institutions. Banks relied on it to process transactions. Governments used it to manage records. Corporations built entire operational systems around it. And once installed, it almost never left. Switching databases was costly, risky, and operationally dangerous. This created what insiders call vendor lock-in. Customers became deeply dependent, and Oracle built one of the most durable revenue engines in tech history. The beauty of this model was its simplicity. Oracle didn't need factories. It didn't need warehouses. It didn't need fleets of trucks. It wrote software once and sold licenses over and over again. Each new customer added high-margin revenue with relatively little additional cost. Maintenance contracts generated recurring income year after year. This asset-light model produced extraordinary cash flow, and Larry Ellison used that cash aggressively, acquiring companies, expanding into enterprise applications, and cementing Oracle's role as a central pillar of corporate IT. For decades, this formula worked. But then came the cloud. Instead of buying software and running it on their own servers, companies began renting computing power from hyperscalers like Amazon Web Services, Microsoft Azure, and Google Cloud. Infrastructure became a utility. You no longer bought the filing cabinet. You rented space inside someone else's data center. Oracle was slower than its rivals to fully embrace this transition. While AWS and Azure raced ahead building massive global infrastructure footprints, Oracle remained heavily rooted in its traditional licensing model. By the early 2000s, many analysts questioned whether Oracle was becoming a legacy company in a cloud-first world. That's when the pivot began. Oracle launched Oracle Cloud Infrastructure, OC1, signaling a strategic shift. But building a cloud business is fundamentally different from selling software. Cloud requires physical infrastructure, massive data centers, expensive networking equipment, long-term real estate commitments, gigantic electricity contracts. Suddenly, Oracle was no longer just writing code. It was pouring concrete. Instead of collecting rent on intellectual property, Oracle was becoming a landlord of physical computing power. For years, OCY grew steadily but didn't dramatically reshape the company's identity. Then came the AI explosion. Large language models and AI systems require enormous computational resources, especially specialized chips known as GPUs. Training and running these models demands vast data centers optimized for power density and cooling. This was Oracle's opportunity. Rather than build its own AI models, Oracle positioned itself as the infrastructure backbone for those who did. It marketed OC1 as a flexible alternative to larger hyperscalers, willing to customize environments specifically for AI workloads. In effect, Oracle became the property developer of the AI era. Investors loved the story. AI demand appeared limitless. Cloud revenue accelerated. And Oracle's stock reflected that optimism. By late 2025, the company was reporting strong top-line growth, with cloud services expanding rapidly at a percentage of total revenue. Leadership emphasized that as cloud scaled, profitability would follow. On the surface, everything looked like a masterstroke. But the transformation from asset-light software empire to capital-intensive infrastructure operator carried risks that were easy to ignore in a rising market. In the old model, Oracle faced minimal physical risk. If a customer left, the code still existed. Margins remained high. In the new model, Oracle was signing long-term commitments for buildings, power, and hardware, whether customers filled them or not. The company had stepped into a very different game. And by the end of 2025, early signs suggested that the cost of this pivot might be far higher than anyone initially realized. By late 2025, the market's tone toward Oracle began to shift. Just months earlier, the company had been celebrated as a clever beneficiary of the AI boom. Now analysts were starting to ask a more uncomfortable question. Was Oracle building sustainable infrastructure? Or placing a massive leveraged bet on a fragile industry? The first crack appeared in December 2025 when Oracle released its fiscal second quarter earnings. On the surface, the numbers weren't bad. Revenue climbed again. Cloud growth remained strong. Management reiterated confidence in long-term AI demand. But the market wasn't looking for good. It was expecting extraordinary. And more importantly, investors had started looking beyond the income statement. Buried inside the filings was a detail that fundamentally altered how analysts viewed Oracle's future. The company had dramatically increased its forward operating lease commitments. In a single quarter, projected lease obligations jumped from roughly $100 billion to approximately $248 billion. That wasn't a rounding error. That wasn't incremental growth. That was an explosive expansion of future fixed costs. Operating leases represent long-term agreements to pay for data center space, land, power infrastructure, and facilities. These commitments often span decades, and unlike flexible software expenses, they don't disappear if demand slows. For a company that once prided itself on being asset-light, this was a stunning transformation. The old Oracle thrived on intellectual property. The new Oracle was signing contracts like a real estate developer in the middle of a construction frenzy. Wall Street reacted quickly. The stock fell sharply following the earnings report. Not because revenue was weak, but because the balance sheet was becoming harder to defend. Then came the leverage discussion. By the end of November 2025, Oracle's total borrowings had surged past $100 billion. Short-term notes and long-term debt combined into a towering liability structure. Yes, the company held cash on hand, but not nearly enough to offset that debt burden. In software, high margins and recurring maintenance fees provided a cushion. In infrastructure, debt servicing becomes relentless. Interest payments don't care about AI hype cycles. And this is where the risk profile truly changed. In its traditional model, Oracle's downside was limited. If a customer churned, the company still owned the code. Margins were protected. The business could adjust. In the AI landlord model, Oracle was fronting capital for facilities built specifically for certain customers, particularly major AI players. If those customers thrived, Oracle would collect rent. If those customers struggled, Oracle would still owe billions on facilities that were highly specialized and difficult to repurpose. The asymmetry became clear. AI developers captured upside from successful models. Oracle absorbed the physical and financial downside of the infrastructure. This lopsided structure made analysts nervous, especially given how concentrated AI spending had become among a handful of companies. Concerns grew around customer concentration risk. If a major AI partner reduced spending, delayed deployments, or renegotiated contracts, Oracle's exposure would be immediate and material. And then came the capital market signal. In September 2025, at the peak of AI enthusiasm, Oracle had issued roughly $18 billion in bonds to finance its expansion. At the time, demand was strong. Investors were eager to gain exposure to anything tied to AI infrastructure. But bond investors are different from equity investors. Equity chases growth. Debt demands predictability. As volatility increased and construction timelines stretched, bond prices began to wobble. Yields rose, questions multiplied. By early 2026, reports surfaced that certain specialized AI-focused data centers were experiencing delays. Completion timelines were reportedly being pushed out by a year or more. In infrastructure, delays are expensive. Debt accrues. Lease payments continue. Revenue waits. Even if Oracle publicly reassured investors that projects were on schedule, trust had already been dented. Then governance concerns emerged. Longtime board members stepped down amid growing scrutiny. Leadership restructuring emphasized operational expertise, a signal that managing large-scale physical infrastructure had become the company's central challenge. Meanwhile, hedge fund activity hinted at skepticism. Some prominent investors reportedly positioned themselves against Oracle shares, citing leverage and execution risk. The story was no longer about visionary reinvention. It was about capital intensity. Capital intensity changes everything. It changes valuation models. It changes tolerance for error. It changes how markets interpret growth. In software, investors reward acceleration. In infrastructure, they demand discipline. By January 2026, Oracle found itself at the center of a new narrative. The AI boom was still alive, but the easy optimism had faded. Instead of asking how high the stock could go, analysts began asking, how resilient is the balance sheet? How concentrated is the customer base? How flexible are those lease commitments? How quickly can cloud revenue scale relative to debt obligations? The company that once enjoyed one of the most durable financial models in tech had voluntarily entered one of the most capital-hungry arenas in modern business, and the market was recalibrating accordingly. What looked like a brilliant pivot in September now looked like a high-stakes gamble by January. The AI landlord strategy wasn't just about growth anymore. It was about survival under leverage. And the most serious test was still ahead. By mid-January 2026, the tension surrounding Oracle's transformation finally boiled over. What had started as quiet analyst concern turned into something far more serious: legal action. On January 14, 2026, a group of bondholders filed a lawsuit connected to Oracle's $18 billion bond issuance from September 2025, the very moment when AI enthusiasm was at its peak and the company's stock was setting records. The allegation wasn't simply that the bonds had declined in value. Markets fluctuate. That's normal. The accusation was that Oracle had failed to fully disclose the scale of risks tied to its aggressive AI infrastructure build-out. Bondholders claimed they had not been given a clear enough picture of the magnitude of long-term lease commitments, the construction and execution risks surrounding specialized AI data centers, the dependency on a small group of AI customers, the potential for delays impacting revenue timelines. When bond prices drop sharply, debt investors don't just complain. They litigate. This lawsuit shifted the spotlight from growth projections to transparency. It forced investors to confront an uncomfortable dynamic. The people who funded Oracle's infrastructure expansion were now questioning whether they understood what they were financing. And that exposed the deeper structural tension in Oracle's pivot. When the stock soared in September 2025, equity holders celebrated. Larry Ellison's net worth surged. Headlines framed Oracle as an AI-era comeback story. But debt is different. Bond investors don't benefit from upside surprises the way shareholders do. Their returns are fixed. Their risk tolerance is limited. If the AI bet works spectacularly, equity captures the reward. If it falters, debt absorbs the shock. That asymmetry suddenly mattered. By early 2026, Oracle was carrying over $100 billion in borrowings. On top of that were enormous operating lease liabilities tied to future data center obligations. When you combined traditional debt with lease commitments, total liabilities approached levels that would have seemed unimaginable during Oracle's software-dominant era. And unlike software code, a half-built AI data center cannot be easily repurposed. These facilities were engineered for extremely high-density GPU clusters, requiring specialized cooling systems and power infrastructure. They were designed for a specific kind of demand: AI training at scale. If that demand slowed, there wouldn't be a long line of alternative tenants waiting to move in. This is the hidden risk of capital-heavy transitions. Specialization reduces flexibility. The old Oracle had optionality. It sold enterprise software across industries. It could raise prices, bundle services, or adjust licensing models. The new Oracle had fixed costs. Concrete doesn't renegotiate. Power contracts don't pause. Interest payments don't wait for hype cycles to recover. As news of the lawsuit spread, the narrative shifted again. The focus was no longer just about whether AI demand would continue to grow. The real question became, had Oracle expanded too quickly, too aggressively, and too confidently in an industry still defining its own economics? Because AI itself, despite enormous excitement, remained a young business model. Training large models is expensive. Monetization strategies are still evolving. Competitive dynamics change rapidly. Hardware supply chains are volatile. And Oracle had tied billions of dollars in physical infrastructure to this ecosystem. The company's defenders argued that this was simply the cost of staying relevant. In their view, Oracle had correctly identified where enterprise computing was headed and was investing accordingly. AI workloads require massive infrastructure, and someone has to build it. But critics saw a different picture. They saw a company that once dominated through software leverage, now embracing financial leverage. They saw management chasing growth in a market driven as much by speculation as by stable demand. They saw a balance sheet that left little room for error. Even Oracle's improving profitability failed to calm nerves. Yes, net income had risen significantly year over year. Yes, cloud revenue was expanding at impressive rates. But profits on paper don't eliminate structural exposure. Free cash flow, debt maturity schedules, and lease rigidity became the new focal points for analysts. As 2026 unfolded, Oracle found itself at a crossroads. It could slow expansion and prioritize balance sheet repair, continue aggressive build-outs and hope AI demand accelerates fast enough to justify the risk, restructure commitments to reduce concentration and exposure. None of these options were painless. Slowing down could signal weakness. Doubling down could amplify risk. Restructuring could strain customer relationships. Meanwhile, the stock price, once a symbol of triumph, remained well below its September 2025 peak. The market was no longer pricing Oracle as a momentum story. It was valuing it as a leveraged infrastructure operator navigating execution risk. The irony was hard to ignore. For 4 decades, Oracle built its empire on software margins that insulated it from physical risk. It thrived on intellectual dominance. Now its future depended on construction timelines, power grids, and bondholder confidence. Larry Ellison may have briefly won the optics of the AI trade, but by early 2026, the real challenge wasn't winning headlines. It was managing liabilities. And the final chapter of this pivot would be written not by hype, but by financial discipline. By the time 2026 was fully underway, Oracle was no longer being evaluated as a legacy software champion, reinventing itself for the AI age. It was being judged as something far less glamorous. A highly leveraged infrastructure operator navigating one of the most capital-intensive pivots in modern tech history. And that distinction matters, because growth stories are exciting. Infrastructure stories are unforgiving. For decades, Oracle's identity was built around dominance. Its database business generated recurring revenue streams so stable that many customers treated them as unavoidable operating expenses. An unofficial Oracle tax. The company's margins were thick. Its switching costs were enormous. Its pricing power was legendary. But the AI landlord strategy rewrote that equation. Instead of charging rent on code, Oracle was now paying rent on land. Instead of monetizing intellectual property, it was financing power grids and cooling systems. Instead of defending margins, it was defending debt covenants. And debt changes behavior. When a company carries modest leverage, it has room to experiment. It can make mistakes. It can endure slow quarters without existential pressure. When a company carries over $100 billion in borrowings with hundreds of billions more in long-term lease commitments, flexibility shrinks dramatically. Capital preservation becomes as important as innovation. As analysts dissected Oracle's financial structure, several structural realities became impossible to ignore. First, the company's exposure wasn't just about debt. It was about timing. Infrastructure spending happens up front. Revenue ramps over time. If demand grows slower than expected, the gap between expense and income widens. Second, concentration risk remained significant. A large portion of Oracle's AI infrastructure was reportedly aligned with a limited number of high-profile customers. If even one major client reduced expansion plans, Oracle would still be left servicing the physical footprint built to accommodate them. Third, specialization reduces resale value. A generic office building can be leased to multiple tenants. A hyperscale AI-optimized data center, built for extreme GPU density, has far fewer alternative uses. These weren't theoretical concerns anymore. They were embedded in the numbers. Markets, especially credit markets, don't ignore structural risk for long. Bond spreads reflect confidence. When lenders demand higher yields, they are pricing uncertainty. And once bond investors grow skeptical, refinancing becomes more expensive. This is the quiet pressure that builds behind the scenes. Equity investors watch stock charts. Credit investors watch cash flow coverage ratios. By early 2026, Oracle's leadership faced a difficult balancing act. On one hand, pulling back too aggressively could undermine its credibility in the AI infrastructure race. Hyperscalers move fast. If Oracle slowed investment while competitors accelerated, it risked losing relevance. On the other hand, continuing at full speed meant doubling down on leverage at a moment when legal scrutiny and bondholder dissatisfaction were rising. There was no easy off-ramp. The lawsuit over the $18 billion bond issuance amplified a deeper issue: transparency and expectations. If investors believed risks were undercommunicated during the AI euphoria, rebuilding trust would take time and disciplined financial reporting. At the same time, leadership transition signaled that operational execution would define the next phase. Running a database empire is different from running a global construction and energy-intensive infrastructure network. In the background, macroeconomic variables added another layer of uncertainty. Interest rates, energy prices, semiconductor supply chains. All of these external forces directly affect infrastructure economics. In software, margins absorb shocks. In infrastructure, shocks hit directly. Perhaps the most striking shift was psychological. In September 2025, Oracle symbolized reinvention. By early 2026, it symbolized risk tolerance. The billionaire founder's soaring net worth had briefly captured global attention. But wealth rankings are snapshots. Balance sheets are ongoing obligations. The AI boom had created extraordinary opportunities across the tech ecosystem. Some companies built models, some built chips, some built platforms. Oracle chose to build the buildings. That decision may ultimately prove visionary. If AI demand compounds steadily for years and utilization rates remain high. But if AI growth cycles prove uneven, if customers renegotiate capacity, or if technological shifts reduce infrastructure intensity, fixed commitments could weigh heavily for years. The central lesson of this transformation isn't about whether AI will succeed. It's about capital structure. A high-margin software monopoly can tolerate missteps. A leveraged infrastructure operator cannot. As 2026 progresses, Oracle's story will hinge less on hype and more on discipline. Can it convert cloud growth into durable free cash flow? Can it manage debt maturities without refinancing stress? Can it diversify its customer base fast enough to reduce concentration risk? Can it align infrastructure build-out with realistic demand projections? These are operational questions, not narrative ones. The first round of the AI trade may have rewarded boldness. The second round will reward prudence. Oracle's pivot from code to concrete is one of the most dramatic strategic shifts in enterprise tech history. Whether it becomes a case study in visionary adaptation, or a cautionary tale about leverage in a hype cycle, depends on what happens next. Because in the end, markets don't punish ambition. They punish imbalance.